In this presentation, I'm going to go through a statement of affairs preparation, which is a subset of the topic incomplete records. So first off, what is a statement of affairs? Essentially, it's a very simplified set of accounts. We prepare two separate balance sheets, which shows assets and liabilities at the start of a period and at the end of a period. Typically, the balance sheet dates will be quite a substantial amount of time between each other, so they may be a 15-month period between the start and the end balance sheet. And as you should know, with balance sheets, you're looking at listing out your assets, your liabilities, your capital, drawings into each separate balance sheet. So a question on this topic presents you with a list of assets, liabilities, and information about drawings and such like, and you have to slot them into the individual balance sheet. The idea behind this is to calculate net profit over the period between the balance sheets. And this is got from the second balance sheet. The capital section of the closing balance sheet will contain the value for net profit. Because in essence, a balance sheet increases over time due to either making a net profit or due to an investment by the owners. So in the absence of an investment by the owners, if you start off with a balance sheet value of say €1,000 and your closing balance sheet has gone up to €1,500, that suggests that you made a profit of €500 over the period. And we're typically trying to determine the amount of the profit over the period. Why might we do this? It seems almost too simple. And usually it's in a situation where there's been something of a financial crisis affecting the business. First main point is we typically need to calculate profit or income earned over the period. And the typical scenario is that the business that we're doing this for has almost no records available. Maybe the business was run by a single individual and he or she just didn't have time to be looking after the financial end of things. It was all about making the sales and keeping the customers happy and keeping the bank balance in check. And all of a sudden the tax office has an issue with that business. So you can envisage the scenario. They need their tax affairs to be brought up to date. Now, in the absence of the normal information, it would be very expensive to hire accountants to prepare a normal set of accounting records. Okay, so you wouldn't be able to justify the time and the expense required to do up things like sales day books and cash receipts day books and to go through a list of bank transactions, simply because it would be too expensive to do so. So we need an alternative method to determine the net profit or net loss over the period, and this is where the statement of affairs comes into play. So two balance sheets, you're going to see now the layout of a question, and just remember two balance sheets, one at the start of a period and one at the end of a period. So how to prepare one? Okay, well, we have two balance sheets, as I said. You've got one at the start, I call that the opening balance sheet, and one at the end, closing balance sheet. And here's your balance sheet elements. It's just a condensed list here. So you've got your fixed assets or non-current assets. That would be things like plant and machinery, motor vehicles, equipment. Current assets, that would be stock, amounts owed by your debtors, money in the bank, and current liabilities. So amounts owed to suppliers, maybe bank loans, taxes owed. And the difference between all your assets and your liabilities gives net assets. And then you've got the other section of the balance sheet, the capital and drawing section. So when you're presented with a question on this topic, you start with the opening balance sheet assets and liabilities. So the question actually has to tell you this information. You'd be given a series of statements either in text format or maybe in table format, and you're required to essentially put those values into the opening balance sheet. So you may be told the business had a car worth €5,000 and had money in the bank of €1,000 but owed suppliers €1,500, and you slot the individual amounts into the individual rows. Now, when you've done your assets and liabilities, this value, the total net assets, must be set to be the same as the closing balance of the other part of the balance sheet. Okay, remember balance sheets, the hint is in the name, they balance. So this total here must match this total here. So that's a kind of I suppose, a little operational point. After you've entered in the data given to you in the question, this total is equal to this total. You don't need to worry about the details in the opening balance sheet for the capital and drawing section. You simply just take that being the total. And that then is transferred to the second balance sheet, the closing balance sheet. So whatever you get here is transferred to the opening capital of the next balance sheet. Okay, and again, that's really probably the only slight technical challenge that's present in these types of questions. They are relatively simple as financial accounting questions go. Okay, so you have your total net assets equals your closing balance on the opening balance sheet, and that equals your opening capital on the next balance sheet. You then have to read through the question to get other elements of information. So at the end of period, the closing balance sheet, the car might now be worth €4,000, and maybe there was some more money in the bank, €1,500, some liabilities, 1,000. Okay, and you'd also typically be told details about drawings of the owner. So maybe the owner knows that on average in a typical week he or she takes out €500 for his or her wages, and depending on the number of weeks, then if it's 52 weeks, you'd have 52 multiplied by 500. If it's more, you would have 500 multiplied by the greater number of weeks. There may be capital introduced. An example of capital introduced is money won on a prize and brought into the business, or money inherited, or money received as a gift from, say, a family member. If it's brought into the business, it's deemed to be capital introduced. So this figure was already entered from the previous balance sheet. We add the capital introduced, we deduct the drawings, and the missing number to make the closing balance sheet totals match each other is your profit or your loss. So the net profit would be the balancing figure, and that's the figure that you're typically determining in these questions. So I'm going to look at the solution to the statement of affairs question Hugh Murray. It's one we actually covered in class prior to the shutdown, but I just want to go through it again so that people are okay with it. I did get a request to go through this particular topic. So just looking at the question to get the key details. So Hugh Murray's been in business as owner of a bicycle outlet for a number of years. Most of his business involves dealing directly with the public. There's some wholesale trade entered into each year. He keeps all bills received and bank documentation in a lever arch file, which he sends to his accountant so that the accounts can be prepared for the tax inspector. Now you're told the last statement of financial position, or the balance sheet for his business prepared at December 18, shows the following. Now there's the first little piece of information. Okay, so this that we're about to look at is his balance sheet that was prepared previously. So that'll be the opening balance sheet. And this shows the following. So you've got all the details listed in quite a helpful format, all the way down to total net assets. Now, one small point that's worth noting is we aren't shown the second part of the balance sheet, which is the capital section. So there's a learning point, probably worth emphasizing, that you would normally need to know the elements of a balance sheet. So I'll just put in a comment to that effect. Okay, so you need to know the capital section of the balance sheet, what things go into the capital section. So that's a learning point that does need to be borne in mind. So what we can start with is we're given the last balance sheet, or the opening balance sheet, and you should know from the previous PowerPoint presentation that that's going to be one of the elements that we need to use in our solution. So I'm going to switch the solution. I'm going to simply incorporate these values into the balance sheet at the start. So switching to Excel. So we have our template drawn up. There's my starting balance sheet and my ending balance sheet. And I need to start by putting in the opening balance sheet assets and liabilities. Okay, so we were given those very helpfully in the question. So this is what I'm doing here. So just taking them directly from the question. I might try to minimize the screen so that it's possible to see both side by side. Okay, so you can see on the left of the screen the balance sheet details, and on the Excel spreadsheet I'm just simply copying those in. So again, nothing too demanding there. Okay, so the 15,830 matches up, the 7,149, all these ones match up, and likewise the liabilities. So that gives us total net assets of 15,254. Now, so focusing now on the Excel spreadsheet. Okay, so we also get the closing capital value. So here's the learning point that I mentioned at the start. You need to know these elements. These typically wouldn't be provided in a question. So there is that little bit of knowledge required, what goes into the capital section of a sole trader's balance sheet. So capital at the start, capital introduced, net profit or loss, and drawings. So what we're now doing is we're taking the total of the top and just saying that that's the closing balance at the base. So I can just simply show this value here, 15,254. So that's that step dealt with. Now what we then do is this number is transferred across to the open capital of the closing balance sheet. So we're going to do that here, so we can slot that in there. Okay, so you see the process, and again this is a very static process. It's a highly proceduralized approach to preparing accounts. Okay, and now we have to enter all the values into the closing balance sheet. So I have to go back to the question to get these details. So you can see all these items highlighted in blue. These need to be entered in. So I need to return to the question to get these details. Okay, so looking at the question, if I just push this to this side. Okay, so cash drawings per month averaged 1,800. Okay, now we're talking about from the end of December 18, so January 2019 to December 2019. So that's 12 months of cash drawings. So that's going to be 12 times 1,800, 21,600. So 1,800 per month by 12 is the drawings. Okay. Hugh won 3,500 in a local lottery. So I'll just actually strike this out. That's now dealt with. Okay. And he launched it to the business bank account. Okay, so this is capital introduced. Okay, remember the idea that capital introduced relates to any money that you bring into the business other than from sales. Okay, so things like winning money and lodging it to the business, or inheriting money, or receiving a gift of money constitutes capital introduced. So 3,500 goes into my capital introduced cell. Okay, so that's that one now dealt with. Okay, so again, strike that out. Now, one item of old equipment shown in the above statement of financial position at a net book value of 700 was sold for €1,000 cash during the year. Well, that's going to affect this value here. My non-current assets have dropped by 700. Okay, there was an item in there that was worth €700 and it was sold. So it's a bit like asset disposal. We have to take everything about that asset out of the balance sheet. Okay, so we're going to have to do a calculation for my non-current assets, but we're also told the depreciation of the remaining fixed assets is calculated using the reducing balance method at a rate of 12.5%. So we've got depreciation to deal with, 12.5%. A full year's depreciation is charged on all assets held at the end of the year, uncharged on any assets disposed of in the year. So we need to figure out what assets do we have at the end. So we sold something, so I have a little calculation to do here. So we start off with saying, okay, what should we have at the start? Well, we had 15,830, and we sold an item which was worth 700 in that value. So one item worth 700 was sold. Doesn't matter how much it was sold for. It could have been scrapped or it could have been sold for €5,000. It doesn't affect this particular calculation. So we now have 15,130, and we calculate depreciation at 12.5% of that. So 15,130 by 12.5% gives us 1,891. So the value that I'm left with, which I'm going to highlight, is the value of balance sheet assets, 13,239. So 13,239. Okay, so we've all the other things to fill in, so let's just look at the question one more time. So we've dealt with all this. Okay, so now closing balances at December 19 were as follows. So again, these are pretty straightforward. So trade receivables 2638. All these items go into the various appropriate columns. So I'll just display those. So these go in as given. Okay, so that's literally just putting these items into the relevant cell in Excel, depending on what the thing describes. And we're pretty much done. So if I just focus now on Excel, I've done this step here, putting in all the blue items. So I need to now figure out the missing figure, which is the profit or loss. So this figure is where the profit or loss will go, this cell here. So I need to just get my subtotals here. So I'll just add these up. So that's 18,814. These liabilities add up to 5,070. So taking the assets minus the liabilities, that gives me this number here. So that's 13,239 plus 18,814 minus 5,070 gives you 26,983. Now, this number has to be the same down here. That's just, as I say, the nature of balance sheets. They match, they balance. So what we now have is this number plus this number minus that number, and then the missing figure add up to 26,983. So if you do the mathematics on that, that's about 18,700 and that's 21,600. So you've got a negative 3,100. So you must have a positive, works out at 29,829, and that is the profit for this particular sole trader, and that is the answer. So you would say that Hugh's profit for the period was 29,829, and that's statement of affairs complete.